Your RMD is not your withdrawal strategy. It's the floor. Everything you take out on top of it and from which account is where the next $200,000 of your retirement gets made or lost. Most retirement advice ends at age 73. You retire, you do Roth conversions, RMDs start, and then that's the end. But RMDs aren't the end of planning. They're the beginning of a 15 to 20 year window where the order you pull money from your accounts determines whether your portfolio lasts to 95, whether your spouse pays the widow's tax penalty, and whether your kids inherit $800,000 or $1.4 million from the same starting balance. This video shows you the post-RMD withdrawal framework, which account to tap, in which order, in which year, and why the conventional wisdom is wrong for anyone with $2 to $5 million. And be sure to stay until the end where I go over a case study that shows how I'm getting a current client an effective tax rate of less than 2% on their money right now using this strategy. Around 7 years ago, I had this client come in and he retired at 66, $3.2 million across 3 account types. Pre-tax IRA at $2.1 million, taxable brokerage at $800,000, and a Roth IRA at $300,000. Over the next 7 years, we executed a plan that set him up to save over $200,000 in taxes before his RMDs even started. We reduced his IRA balance to around $600,000. His brokerage account grew to about $1 million, and his Roth was worth $1.4 million. We had set him up to have to never pay Medicare surcharges, never tip beyond the 22% bracket, and live nearly tax-free after his pre-tax IRA was spent down. His RMD in year 1 was about $25,000. His spending need was $140,000. Social Security between him and his wife was $70,000. So he needed to pull another $45,000 from somewhere. He thought he would pull it from the brokerage because it was more tax efficient. He thought we were done with Roth conversions because he was not allowed to do them after he retired. He thought there was nothing left to do. Doing nothing would have cost him $200,000 in taxes. And here's why the conventional order of taxable first, pre-tax second, Roth last was designed for a world where the pre-tax account was small relative to the others. For individuals with $2 to $5 million, the pre-tax account is usually the biggest or second biggest account, which means by following the conventional order, you're letting the largest, most tax toxic account compound the longest and detonating it on your spouse or your kids later on. The right answer isn't taxable first. It isn't pre-tax first. It's bracket filling. And once you understand it, the order of withdrawals becomes obvious. Stay to the end. I'm going to walk you through the 3 account decision framework, the specific year-by-year withdrawal sequence, and the 2 situations where the conventional order is actually correct so you know when to break the rule and when to follow it. I'm Ryan Knoll. I'm the founder of Nav Wealth Partners. We're a firm that specializes in the distribution phase for households with $2 to $5 million. The post-RMD years are the part of retirement that gets the least planning attention and is some of the highest dollar consequences. That's what this video is about. The conventional withdrawal order, taxable, then pre-tax, then Roth, comes from a textbook example where the retiree has small accounts and a long life expectancy. The logic was to defer taxes as long as possible, preserve tax-free growth the longest. That logic breaks down for a $2 to $5 million retiree for 3 reasons. Reason number 1 is the pre-tax account is too big to defer. When your pre-tax IRA is $2 million and growing at 6% per year, RMDs start around 4% of the account balance. By age 85, the RMD divisor is 16, which means you're forced to withdraw even more, about 6.25% of the balance. By age 90, it's nearly 9%. The IRS doesn't let you defer forever. They've built a mandatory drawdown curve, and that curve accelerates. If your pre-tax account keeps compounding because you're pulling from the taxable first, you're not deferring tax. You're concentrating it into the back half of your retirement when your brackets are higher, your spouse may be filing single, and your IRMA exposure is more sensitive. Reason number 2, the widow's tax trap is real and it's expensive. When the first spouse dies, the surviving spouse files single the following year. Single brackets are roughly half the width of married filing jointly brackets. The same income that was taxed at 22% married, well, that jumps to 32% for a single filer. The same income that triggered no IRMA surcharge for married couples triggers a $4,000 to $10,000 Medicare surcharge when you're single. If you've spent the first 10 years of retirement preserving the pre-tax account, you've handed your surviving spouse a tax bomb. The conventional order makes this worse. Now the final reason number 3, the inherited IRA 10-year rule. The Secure Act killed the stretch IRA. When your kids inherit your pre-tax IRA or any IRA for that matter, They have 10 years to fully distribute it, usually during their peak earning years. That money comes out at their marginal rate, which for most successful 40 to 50-year-olds is somewhere between the 32 and 37% rate when you factor in what they have to take from your portfolio. If you'd pulled some of that money out at your 22 or 24% bracket and either spent it, gifted it, or moved it into Roth or taxable, you'd have saved your kids 10 to 15 percentage points of tax on every dollar you work so hard for. The conventional order ignores all three of these realities. So what do you do instead? The right way to think about post-RMD withdrawals is not which account first, it's what bracket am I in and how much room do I have left. Here's the framework. Step 1, start with your RMD as the floor. You have no choice. The RMD comes out of pre-tax accounts and shows up as ordinary income whether you need the money or not. That number is fixed. Build everything else around it. Step number 2, you want to identify your target bracket. For most $2 to $5 million retirees, the target bracket is either the 22 or 24% federal bracket. Ideally, you target the 22% bracket if it allows you to wind down your IRA efficiently. Going too far above that bracket will trigger Medicare surcharges that only further eat into your portfolio. Dipping into the 24% bracket is not always bad because you want to make sure you avoid ever hitting 32%, because that 8% jump is one of the most expensive in the tax code. It needs to be avoided at all costs. Step 3. Fill your target bracket with the right account. Once your RMD is in, calculate how much room you have left in your target bracket. That's your bracket headroom. If you need additional cash flow and you have bracket headroom, the first order is first to take additional pre-tax withdrawals up to top it off. Yes, that's more pre-tax on top of the RMD. This is the opposite of the conventional advice, and it's the right move. This is how you avoid the 32% bracket later on in your retirement. Second, if you still need cash flow after filling your target bracket, switch to the taxable account. Long-term capital gains in the 22 and 24% ordinary bracket are taxed at 15%. So taxable becomes more efficient than pre-tax once you've maxed out that bracket. Third, and rarely needed, is consider Roth only for spending that would push you into the 32% bracket. Roth withdrawals don't show up on the tax return at all, which means they don't affect IRMA, they don't affect Social Security taxation, and they don't affect capital gains brackets. The Roth is your overflow valve. And then step 4, rerun this math annually. This is the part that nobody does. Your bracket headroom changes every year based on RMD growth, portfolio performance, Social Security cost of living adjustments, and one-time income events. A withdrawal plan that was right at 73 is probably wrong at 78. Most retirees set the plan once and never revisit it. That's where the $200,000 over 15 years comes from. If this framework is new to you, be sure to throw this video a like and subscribe to the channel. We specialize in helping clients in the $2 to $5 million asset range with all aspects of their retirement, from accumulation to spending and every decision in between. We have a video to cover it for you. And if you have a specific question you need answered or video you want us to do next, leave a comment so we can start working on it. Now let's jump back into the video. So there's 2 situations where you should ignore everything I just said and follow the conventional order. Situation number 1, you have a charitable intent. If you're planning to leave significant money to charity, the pre-tax account is the most efficient asset to give. Charities don't pay tax and IRA distributions. Your kids and your spouse do. So if 30% or more of your estate is going to charity, preserve the pre-tax account. Spend the taxable first, and use qualified charitable distributions, also known as QCDs, to satisfy your required distributions directly to the charity. That eliminates the RMD from your taxable income entirely. The second situation is if you have a large concentrated position with embedded gains. If your taxable account holds a single stock with a huge embedded gain, company stock from a prior employer, or just a long-held position are good examples, the step up in basis at death is worth more than the bracket filling savings. Hold the position, spend the pre-tax, and let your heirs inherit at stepped-up basis. Outside of those 2 situations, bracket filling will likely beat the conventional order for most $2 to $5 million households almost every time. Remember the client from the beginning of the video? Here's exactly how we got him to a less than 2% effective federal tax rate. After all deductions and spending needs are met, our retired couple has roughly $115,000 of Roth conversion space available to them in the 22% bracket, and we're going to use all of it. Following that plan, we would have wound down their IRA around age 76. At that point, the brokerage account is worth about $1.25 million. 30% of that is gains, and the Roth has grown to around $2.5 million. Now, the next step is one that is totally different than what they expected. They expected to continue pulling from retirement accounts since the distributions were tax-free, being that they were all in Roth at this point. But what they did not realize is that most of their capital gains were tax-free as well. As long as they kept their taxable income below $98,900 in 2026, all of their capital gains are going to be tax-free. Anything that crosses that threshold, well, that's taxed at 15%. So let's do the math. Their only guaranteed income source is their $70,000 worth of Social Security. That's up to 85% taxable and gives them a starting gross income of $59,500. Then they take their standard deduction of $35,500, which includes the 65 plus additions, and taxable income is now only $24,000. So that means they have $74,900 of gains they can recognize completely tax-free. We know that they spend $140,000 a year, which means they need to pull another $70,000 from brokerage to supplement their Social Security and meet their needs. The brokerage withdrawal is 30% gains, which is what gets added to their taxable income number. That $70,000 withdrawal adds $21,000 of capital gains to their taxable income number. So total taxable income is now $45,000. That's well below the $98,900 threshold, and therefore they'll pay no taxes on that distribution. The best part is that they're not even done yet. They then want to make sure they're using up the rest of their 0% capital gains bracket by harvesting gains and resetting their cost basis to help them save on future tax burdens. But they essentially have federal tax liability of $2,400. That works out to an effective federal rate of under 2% on $140,000 of annual spending for the rest of their life. Here's the bottom line. RMDs aren't the end of tax planning. They're the start of a 15 to 20 year sequencing problem that has bigger dollar consequences than anything you did in the accumulation phase. The conventional withdrawal order, taxable first, then pre-tax, then Roth last, was designed for a different retiree than you. For households with $2 to $5 million and a pre-tax account that dominates the balance sheet, bracket filling is the right framework. Build a 22 or 24% bracket with pre-tax, use taxable for overflow, save Roth dollars for the dollars that would push you into the 32% bracket or higher. Rerun this math every year, and know the two situations where you flip the order. If you want to know your specific bracket headroom and which account you should fund your next withdrawal, there's a link to my calendar in the description. Bring your most recent tax return and your account balances. 30 minutes with my team will tell you whether you're leaving money on the table, and they'll help you figure out how you get to a less than 2% federal income tax rate on over $140,000 of income. I'll see you in the next video.